let's talk about the review of the first half, the second quarter, as well as the month of June, which has just ended not too long ago, just about some 48 hours ago. And we'll be bringing Orelua Odetunde to tell us more about this market. We're going to be reviewing that with her. Thank you for joining us, Orelua.
Thank you for having me.
I'm sure that the fixed income market, it really performed well. I'm just guessing. But can you tell us what was the overall performance for both the Treasury bills market, the bonds market, actually the debt markets? Can you give us a little bit of insight into the performance?
Certainly, and like you rightly mentioned, we did see bullish activities really dominate market sentiment in the first half of the year. I mean, I think when we ushered in the Q1, we did see that in the first quarter there was a Treasury bill issuance, there was a Treasury bill calendar issuance, and it definitely showed that there were supposed to be some net injections at about 900 billion into the market. So definitely investors started to price in more liquidity in the fixed income market, and it sent a very strong signal to them as well. Aside from that, I think also in the bonds market as well, we also saw that, you know, there was a 10-year bond that was issued in January 2025, but as of February 2025, that 10-year bond was taken off. So it was clearly signaling, and you know, that 10-year bond was also issued at, you know, 22.6%, which was the highest coupon debt that we currently have on offer. So, I mean, investors took it out in the next auction in February, clearly to signal that they were moving away from the high yield or the high coupon debt environment, so to say. Apart from that as well, we also saw foreign portfolio investors. There was a surge of foreign portfolio investments in the fixed income market. I remember that OMO yields, we saw OMO yields in December 2024 at around 31%. But, you know, I think that, you know, that also brought about a lot of stability in the FX market. We did see that, you know, FX rates started to also stabilize when foreign portfolio investors started to come into the market. As a result of that, OMO yields started to make their way down. OMO yields that were around 31%, I think currently they are now around 24, 25%. So, you know, foreign investors got comfortable with our market. They started to bring more inflows in due to the stability that we saw in the FX environment. And as well as inflation as well. We saw inflation make its way down. As of the last print, inflation was around 22.97%. So I think that investors also priced, you know, those lower inflation numbers into the fixed income performance in the H1, and that was why we saw, you know, very bullish sentiments that rocked the market in the first half of the year.
I'm glad you mentioned insurance. So I said insurance, inflation.
Yeah.
Inflation is one of the key determinants of the market sentiment, even in the equities market. But can you tell us more about this inflation imprint, particularly for the month of June, comparative with the month of May? How did it affect investor sentiments?
I think investor sentiment generally about this new inflation series we're seeing, I think sentiment was a little bit mixed.
The rebased one.
Yes, the rebased one, so to say. So I think on the positive side, we did see, I mean, investors getting much more comfortable with our inflation numbers, because in terms of like our food index weightage, it's much more comparable to where we see other African economies. You know, they also have a 40% weightage on their food index. So it means that to foreign investors will be much more comparable across other sub-Saharan African economies. They don't necessarily need to adjust our inflation figures, you know, to a lower weightage of food. I think the second thing also that, you know, we saw, I mean, for investors that they got more comfortable with was also the fact that, you know, this inflation figure was now much more reflective of consumers' consumption patterns as well. You know, there were introductions of new indexes, so we're starting to see more color on inflation, so to say. So, but I think the negative on the flip side, what we saw was that, you know, there was a new methodology, but I mean, what we saw was that this MBS didn't necessarily release you know, the previous inflation figures under the new methodology. So I think now inflation is a bit more difficult to forecast. A lot of analysts don't have those historical data. So, you know, the history definitely informs where the future inflation figure should be. So, I mean, we don't necessarily have those, you know, past inflation figures to use to forecast these newer inflation numbers. So I think put all of that together, I think perception was somewhat weak, but, you know, so to say, overall, it was mixed sentiments that played out on the inflation data.
Okay, so now when you now mention this, we're still looking at inflation, because in the next 2 weeks we will be expecting the June inflation numbers to be out and for this month of July. So looking forward for the second half, third quarter, and this month, what are your expectations?
So I think our expectations is that, you know, we do expect to see more issuances in the second half of the year. Recall that, in H1, what they have raised in terms of like the domestic debt market, particularly in the bonds market, is around 2.8 trillion. And compare that to 2023, I think they raised around 3.5 trillion. 2024, they raised around 4 trillion. So it's clear that we are seeing lower issuances this time. But we expect that, there will be a pickup in H2. We have a record budget, definitely over 50 trillion. We also have a record budget deficit as well. They will need to, definitely fund that. They will need to fund that, budget deficit gap, definitely. And we know in terms of revenue, we also expect some form of revenue shortfall as well. Remember that we call that, 60% of our oil, 60% of our revenue is expected to be generated from oil, especially oil prices. And we've seen oil prices that is currently below, $75 per barrel in terms of the benchmark, and also oil production as well is way below, what the federal government has already set for its estimate of its revenue in 2025. So I think clearly we should put all of these factors. We also expect a revenue shortfall around 7 to 8 trillion as well. We expect that investors will start to price that in, and that will have, some impact on fixed income yields, which we expect to go higher in H2. But I think one thing that this the DMO is currently trying to do is kind of manage its borrowing cost. So if you take a look at the May bond auction that we had, as well as the June bond auction that we had, you would see that they were clearly raising what they had on offer. And we know that, previously the DMO had that penchant of always wanting to raise more than they offered to the market. But this time they raised exactly what they offered to the market. So clearly they are trying to manage their borrowing cost. But, in the second half of the year, like I said, we have a high budget deficit, we have a high, we have revenue most likely that will have a shortfall. So, so to say, we do expect that issuances should be higher in the second half of the year.
And I'm hoping also that the government will be able to reduce its debt, because the debt has ballooned to about 149 trillion naira as at the end of the first quarter of 2025. But we thank you so much for your analysis on the show. Orelua Odetunde, research analyst with Ancoria Asset Management. Thank you so much for your time.
Thank you
on the show. And we hope to see you next time doing the same thing that you're doing right now.
Thank you.